The 2024 Real Estate and Bank Crisis, a historical pattern unfolding. The year 2024 is predicted to be marked by a significant increase in bank failures, leading to the consolidation of the banking system and a concentration of power among a few large banks. This pattern of crisis and consolidation has occurred throughout history, with different catalysts triggering each event. In the past, mortgage-backed securities caused the collapse, while this time it is the commercial real estate market. By examining historical patterns, we can gain insights into the current situation and its potential consequences. The evolution of banks. The first banks were essentially gold storage companies, where individuals would deposit their gold coins for safekeeping. They would receive a receipt that represented their claim on the stored gold. Over time, people began using these receipts as a form of payment, eliminating the need to physically retrieve the gold. Banks realized they could lend out the deposited gold, leading to the creation of loans and the accumulation of leverage. However, this practice often resulted in banks taking on excessive risk, leading to bank runs and eventual collapse. The role of central banks. Around 300 years ago, central banks were established to mitigate the risks associated with individual bank failures. These central banks acted as banks for banks, providing support to troubled banks during times of crisis. While this approach addressed individual bank risk, it increased systemic instability, as seen in the Great Depression of 1929 and subsequent crises. Historical patterns of bank failures. Throughout history, the pattern of bank failures has remained consistent: deposits, loans, over-leverage, bank runs, and collapse. This pattern was evident in the savings and loan crisis of 1980 and the Great Financial Crisis of 2008. Following these crises, there was a consolidation of the banking system, with larger banks absorbing the assets and liabilities of smaller banks. This resulted in fewer banks, increased concentration, and greater central control over the financial system. Current indicators of bank risk. Recent data suggests that small banks have a higher exposure to commercial real estate loans compared to larger banks. Commercial real estate is facing significant challenges, with experts predicting a generational change and potential market turmoil. The performance of small banks in the stock market reflects these concerns, with many experiencing significant declines. Regulators, including former Federal Reserve Chair Janet Yellen, have also expressed worries about bank stress due to commercial real estate losses. The Federal Reserve's response. The Federal Reserve has acknowledged the challenges faced by small banks but believes the situation is manageable and does not foresee a repeat of the 2008 crisis. However, Chairman Jerome Powell has acknowledged that some smaller banks may need to be closed or merged as a result of the crisis. Preparing for the crisis. To navigate the upcoming crisis, it is advisable to keep cash in high-yield savings accounts, money market funds, treasury bills, and large banks. It is also recommended to stay hedged and consider using strategies like debit spreads to bet on potential bank failures or lack of bailouts. These strategies limit potential losses while offering significant upside potential. Conclusion. The historical pattern of bank failures and consolidation is unfolding once again, with the commercial real estate collapse serving as the catalyst this time. Small banks with high exposure to commercial real estate loans are at greater risk, while larger banks are expected to absorb their assets and liabilities. By understanding this pattern and taking appropriate measures, individuals can protect their finances and potentially capitalize on the crisis.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.